Fund flows suggest hedge funds are gingerly buying stocks again following that 10% pullback in the S&P. Is it time for you to do the same? Joining me now at Post 9 is Morgan Stanley Private Wealth Management's Sherry Paul. Welcome back.
Thank you.
I mean, I think everybody, I don't care what your income spectrum is, how much your net worth is. Everybody wants to know what is going on with these markets. This is not what I expected. And now is it time to get back, positive?
Yeah. Well, look, there's a lot of chaotic thinking out there, and the way that we're simply talking to clients about this is in sort of three viewpoints. We have a 20,000-foot view, which is this discussion around, is it recession, is it stagflation, maybe impossibly. And the bottom line is that we're gonna have that question answered in arrears, because markets are forward thinking. And so if you think we're sort of in a recession, you could argue that the market already reset from the highest peak to trough, north of 10%. Pullbacks typically would indicate some type of a slowdown. And then the 10,000-foot view, the way we see it, is the tariffs, which really then speaks to geography and supply chain. And then really what the sector rotation should possibly be in terms of where tariffs may land. But I think the most important thing that we're wanting investors to pay attention to is the 1,000-foot view, which is really what's happening in the market. And the setup right now is that the S&P is kind of flat. NASDAQ's down maybe, 3 or 4% in any given day. If you take out the top 7 stocks out of the S&P, you'd actually have a positive S&P. And 80% of companies that reported in the fourth quarter actually had positive earnings momentum. And so while we might experience a setback, we want to stay focused on what does that core portfolio need to be right now. And it frankly needs to be an all-weather portfolio to set in the conditions in which we're investing right now.
I'll get to the breakdown of that in a minute, but just to push back on one thing you said, which I think is a relevant part of the conversation. Granted, we had a 10% pullback in the S&P, but we were at what some would suggest was an extended multiple to begin with, right? 22.5 times. Did the multiple reset enough in that 10% pullback if, in fact, we have a recession? Because I could say, well, if 18 or 19 times was the reset, that's probably too high if you're going to go into a recession, isn't it?
Well, is it, though? If, 490 stocks didn't really participate in the momentum of the last 2 years where we had these enormous double-digit returns.
But aren't all earnings going to come down in a more dire economic predicament?
Well, but a reset is not a recession. So course corrections are a normal part of investing, and recessions are not to be necessarily feared. They're not catastrophic events, but I do think investors have some PTSD in America because the last 20 years of recessions have been unexpected catastrophic events. This is feeling in some ways noetically similar because it feels so self-inflicted. And I think that that's the thing that people are having a hard time grasping, and that's why we saw the consumer sentiment number, kind of like plummet in the way we have. And I think, Scott, that this is the most important thing for people to understand that's unique about the U.S. economy, is that what we think, we manifest. We're a 70% consumptive GDP society, so how we think and feel actually has a material impact on how we spend. And so I think that the chaos at the 20,000-foot level and 10,000-foot, if taken too far, could tip that consumer. And we saw what the CFO study came out today, too, about the expectation around recession. But if we continue to talk it up, then we're going to self-fulfill it.
I mean, the Fed seems to keep suggesting that soft data, right, the surveys that you're really alluding to, don't necessarily translate into the hard data of a slowdown in spending. You're suggesting that that's a mistaken view.
Well, remember, economics and economic numbers, they operate in the same parallel universe but different time zones of the stock market. Because the stock market's forward thinking and economic data is trying to confirm what happened in the past that everyone's been speculating about. So as a portfolio manager, my responsibility is to find the corridor of opportunity in every market condition to make money for clients. And right now, a balanced portfolio, all weathered, you're going to get 3 to 4% on your bonds with a chance for some capital appreciation. If we hit that recession, then rates maybe go lower faster. And then the core portfolio setup needs to go back to that free cash flow of dividends. And I think we get a shot at buybacks if companies are feeling like they're stalling out on M&A, which is sort of where the big trade was at the beginning of the year. Maybe they start raising dividends and buying their own stock back, and that's good for shareholders.
What does your words, all-weather portfolio look like? I mean, what is the breakdown for people?
Right down the middle. So you've got consumer staples, things that people are going to, in simplest forms for for people who are watching this show for important information to improve their financial well-being, things that we know that people are going to buy no matter the cost increase. So it's very simply, it's going to be staples, it's going to be healthcare. It has on the long end the enduring thematic of tech. I would encourage investors to continue to hold that as a position in the portfolio. It involves that core, energy. It doesn't include consumer consumer discretionaries and things that feel like they're not a must-have, but a wow, I would love to have. And that's really the basic setup of a core portfolio, and leaning into dividends and income. The dividends and income just become that free cash flow. And the way I describe it to people, it's like if you buy a house and you rent it out and the price of the house fluctuates, but you're getting that cash flow, it has meaningful impact for the market cycle.
But bottom line is a bit more defensive tilt to what you otherwise might have had.
Yeah.
From your expectations at the beginning of the year.
Definitely. It's more practical. People get stressed out when they resist reality. And the reality has shifted. And so we have to shift with it. And the amazing thing about the U.S. capital markets is there are a lot of different places for us to, because of the liquidity and the transparency and all the incredible companies in the S&P 500, for us to make that pivot. And so, yes, people should have that posture, but not, stampede and exit out of the market, which I would not recommend, which is that full error of timing.